Hey there, Iggy the Investing Iguana here, and today we're diving into a topic that's been raising eyebrows in the financial world. Singapore's a whopping $800 billion debt. Let's dive deeper into this intriguing topic. You might be wondering, is Singapore heading for trouble? But fear not, because in this video, we'll uncover the truth behind Singapore's unique debt strategy. We'll explore why Singapore's debt is so high, how the country manages its debt differently from others, and ultimately, whether this massive debt is a cause for concern or a testament to Singapore's forward-thinking fiscal management. Singapore's $800 billion debt may seem like a staggering amount, but it's essential to consider the context. You see, Singapore is a thriving nation with a robust economy, and its debt is actually a result of a deliberate strategy to manage its finances effectively. The majority of this debt is owed to local investors, and it's used to fund various public projects and initiatives that drive economic growth. In fact, Singapore's debt to GDP ratio is remarkably low compared to other developed nations. This indicates that the country has a solid foundation to manage its debt sustainably. Moreover, Singapore has a reputation for prudent financial management, boasting a AAA credit rating from major rating agencies. So, while the sheer size of Singapore's debt may raise eyebrows, it's crucial to look beyond the surface and understand the underlying dynamics. By doing so, we can appreciate the intricacies of Singapore's financial landscape and why this debt isn't necessarily a cause for concern. Understanding Singapore's unique approach to government borrowing and fiscal management is crucial to grasping the context of its debt. While the debt to GDP ratio may appear alarmingly high, it's essential to delve deeper into the specifics. Singapore's government issues debt in the form of Singapore Government Securities and Special Singapore Government Securities, but the purpose behind this borrowing differs significantly from that of other nations. Unlike countries like the US, which often rely on debt to finance their budget deficits or fund various government programs, Singapore's borrowing strategy is more nuanced. The majority of Singapore's debt is actually used to invest in its own assets, such as its sovereign wealth funds, and to finance various public projects that drive economic growth. This approach allows the government to maintain control over its finances while also generating returns on its investments. Additionally, a significant portion of Singapore's debt is held by local investors, such as pension funds and individual savers, which reduces the country's reliance on foreign creditors. This distinctive strategy enables Singapore to manage its debt effectively, making it an outlier among nations with high debt levels. Let's dive deeper into the purpose of Singapore Government Securities, SGS, and Special Singapore Government Securities, SSGS. The SGS play a crucial role in developing the local debt market, which is essential for the growth and stability of the financial sector. By issuing SGS, the government fosters a vibrant and liquid bond market, providing a platform for local businesses and institutions to access funding and manage their financial risks. Additionally, the SGS help the government manage the country's liquidity and control inflation, ensuring that the economy remains stable and sustainable in the long run. On the other hand, the SSGS serve a distinct purpose. These non-tradable bonds are specifically issued to the Central Provident Fund, CPF, a mandatory pension fund for working Singaporeans and permanent residents. The SSGS help manage the CPF funds, ensuring that the pension fund can meet its liabilities to its members, providing them with a sense of security and stability in their retirement. Singapore's financial management is truly remarkable, and its history of budget surpluses is a testament to its prudent approach. Unlike many other nations, Singapore has consistently reported budget surpluses, thanks to its conservative expenditure policies and effective tax system. This means that the government has regularly taken in more revenue than it has spent, allowing it to build up a significant reserve of funds. But that's not all. Singapore has also wisely invested its wealth through sovereign wealth funds like Temasek Holdings and GIC Private Limited. These institutional firms have generated billions of dollars for Singapore, not only covering budget shortfalls when needed but also reinvesting the surplus funds back into the economy, driving growth and development. The Significant Infrastructure Government Loan Act, SINGA, is a prime example of Singapore's forward-thinking approach to fiscal management. Proposed in 2021, the act allows the government to borrow up to 90 billion Singaporean dollars for up to 50 years to fund major, long-term infrastructure projects. This strategic move enables the government to invest in critical assets that will benefit future generations, while spreading the cost over their useful life. By doing so, the financial burden is distributed more evenly, ensuring that the current generation doesn't bear the brunt of the expenses. This approach underscores Singapore's commitment to prioritizing long-term investment and infrastructural development, setting it apart from other nations. When we consider Singapore's financial situation as a whole, it becomes clear that the country's gross debt figure can be misleading. Despite having a significant amount of debt on paper, Singapore has zero net debt, meaning its financial assets far exceed its liabilities. This is a testament to the country's prudent fiscal management and its ability to balance its finances effectively. Let's summarize the key points to take away from our discussion on Singapore's debt. Firstly, it's important to understand that Singapore's high government debt is not a result of budget deficits, but rather a deliberate approach to borrowing and fiscal management. The issuance of Singapore government securities and special Singapore government securities serve specific purposes, such as developing the local bond market and managing pension funds. Additionally, Singapore has a history of reporting budget surpluses and boasts significant sovereign wealth funds, which have generated billions of dollars for the country. The Significant Infrastructure Government Loan Act, or SINGA, is another example of Singapore's forward-thinking approach, allowing for long-term borrowing to fund major infrastructure projects. By keeping these points in mind, we can gain a better understanding of Singapore's unique financial situation and what we can learn from its approach. And remember, I'm Iggy the Investing Iguana, here to help you navigate the complex world of finance and stay savvy.